For the Investing News Network, I am Brian McGovern, here today with Elliot Johnson, Chief Investment Officer and Chief Operating Officer with Evolve ETFs. Elliot, thank you so much for your time.
Thanks, Brian.
Elliot, you're the point man for Evolve ETFs regarding the cannabis market, and you also run the two ETFs that the company offers. Can you briefly explain the ETFs, the strategy for them, and sort of what your day-to-day looks like?
Yeah, sure. So we have two ETFs in the cannabis space. The first one, Seed, focuses on cannabis companies excluding the United States, but everywhere else in the world. And the second one, the ticker is USMJ, focuses only on companies that operate in the US cannabis market. And we've been operating these two products in the same way over the course of their lives. And what we really need to do every day is figure out what the investing landscape looks like and make sure that we're positioned appropriately in both categories. So first of all, our day starts with the portfolio construction task. At the beginning of every day, we make sure that we have the exposures that we want to have to the companies in the portfolio. And the reason that we have to refresh this every day, and the reason that we feel active management is so valuable, is because there's so much volatility in this sector that we can have a single name move by 10% in a given day. And that requires us to reassess and make sure that we have the exposures that we expect. So both products are actively managed by our team at Evolve. And we have a database of about 250 cannabis companies globally that we're looking at. And the first thing that we do when we're trying to figure out how to invest in the market is we divide up the large cap companies from the emerging names and make sure that we have exposure to the large cap companies in a different bucket in our portfolio than the rest of the cannabis companies. We do that largely out of risk management and to make sure that we have the right portfolio construction to take advantage of the larger momentum trends in the cannabis sector. When we found that the market runs higher, tends to be the larger companies perform more than the smaller companies on some of those trends. And the same is true when the market is correcting. So the first thing we do is make sure that we've got the right weighting of the companies in the right categories in the portfolio. We check to make sure that we've got the right risk measures in place. And then really the rest of the day is through news and research and talking to the businesses, making sure that we understand what each company is doing, that we understand legislative changes in the various countries, and that we're keeping an eye on where we think the trends are going overall in the industry to provide the right kind of exposure for investors.
Yeah. For your first cannabis ETF, Seed, you guys have announced some very solid results recently. I believe on the 1-year anniversary of its inception, you announced a 40.63% return. And so far this year, at the end of May, we have seen a 26% increase for the ETF. Can you talk about how do you guys go about getting these results when the market has become quite volatile, has offered a lot of pitfalls to a lot of investors in the space?
Yeah, it really comes back to our active management approach. So when we segment the market into various different market cap categories, and then within each category, we look and make sure we have exposure to all the various different pieces of the vertical cannabis business. So we want to make sure we have the right people who are doing the cultivation and extraction pieces of the business. We want to make sure we've got the right brand and retail companies in there, the ones that we think have the most likelihood to succeed and drive growth for the portfolio. That portfolio construction and fundamental research of the industry is a key part of us picking a more concentrated portfolio, often between 30 and 40 names, than just broadly buying the index. The broad index is going to express what everybody's doing, and oftentimes is just market cap weighted, and that's it. But because of the volatility in the names, you want to make sure you're paying careful attention to every position in your portfolio each and every day. And I can give you an example from last year of one of the names that we took a position in and how we reacted to it. Afria, which a lot of people are aware is one of the biggest Canadian companies, was trading at around $23 a share in September, and then traded down to close to $5 a share in December. Well, our risk monitoring tools caused us to exit the position at around $20, and we were out as it continued to fall further and further. But when it approached $5, we started to become very interested again, because it really didn't make any sense to us that the company would be worth only 1/5 what it had been worth only 6 months earlier. And so we started to take a look at it. We looked at the news, and a lot of the news had to do with senior management, but wasn't really about the company itself. And so we decided that it deserved a place in our portfolio, and we added it back. If you took a passive approach where you were simply market cap weighting your portfolio every day or on a rebalance schedule, you would have more of it at 23 and less of it at 5. which doesn't really make sense if you want to actually buy things when they're cheaper and sell them when they're more expensive. And so we think that that's really a big part of the active management approach that we need to be taking for investors, to give them exposure to the market at the right time, but to pay attention and to not allow a declining position to impair the capital in the fund, but to defend capital on the way down, as well as being in the right place on the way up. And really, it's a lot of that work combined with our fundamental research that's allowed us to outperform over the past year.
Yeah. Elliot, you mentioned the investor sentiment, and that obviously has dominated the sector for a long time now. In terms of other investment trends moving into the second half of 2019, what are your expectations for the cannabis market? Obviously, a lot of interest still for the U.S. space, but are you seeing anything new pop up, or just still a lot of focus for U.S.?
Yeah, so maybe we can talk about Canada first. In Canada, domestically, the big piece of interesting trend over the course of the next year is going to be continuing the rolling out of retail across the country, as well as edible and consumable products, so candies, beverages, cookies, and so forth, coming online in the fall. That's going to drive, I think, a lot of consumer interest, and it's also going to be a time where Canadian companies can experiment with what might work and what might not work, and see what the kind of match is to the market demand of some of those new formats. The other Canadian story is really of the global expansion of Canadian cannabis businesses. Canadian companies have had a head start, and as a result have some of the best talent, technology, intellectual property, and access to capital of any cannabis companies around the world. And so whether you're looking at Europe or South America or Australia, you're seeing Canadian names popping up all the time as Canadian companies expand globally, while other countries come along and legalize and deregulate cannabis the way that Canada has. And so I think that global opportunity justifies a lot of the valuation of Canadian companies. But that being said, the biggest cannabis market right now for domestic consumption is the United States. And what we see when we look at valuations of US-only companies is that they trade at about a 20 times discount to their Canadian peers on an expected 2020 revenue basis. And that discount is largely the result of the discontinuity in legislation in the US, and as a result of the fact that really it's only retail investors who are in that space right now. Big institutions simply aren't there. And it's unusual in an emerging industry for the retail investor to get the first bite at the apple, but that's exactly what's happened due to the discontinuity in legislation in the US. We think as the US deregulates, as some of the catalysts for change take place, for example, some of the legislation going through the Senate and the House right now in the US, that will open the door to more investors moving into the United States. It'll allow US businesses that operate in more than one state to rationalize their operations and become more efficient. And it'll allow them to then address the broader US market. We think that those are tremendous opportunities for developing value for investors south of the border.
Okay. Elliot, another very interesting point of the market so far has been the increased interest in the beverages that are set to become legal later this year in Canada. What's your stance really with these products? There's been a lot of debate regarding how valuable they will be, how much market they will take. There's been debate about as whether or not they really have that cachet with consumers, or how much will they gain immediately. And I believe Deloitte has issued a projection of $529 million per year to be worth for just beverages. A lot of interest. Beverage companies have come into the market. Where do you really stand with these products? Do you foresee them taking over, or how do you see them moving forward?
Yeah, so first of all, estimates are exactly estimates. Nobody really knows what's going to happen, and that's one of the exciting things about these new formats of edible and consumable beverages coming into the market. Nobody knows what the next Coke or Pepsi or Molson Canadian there's going to be of cannabis drinks. The fact that you've got Constellation investing in Canopy Growth, Constellation Brands is a huge beverage company in the US, InBev or Budweiser making investments, and Molson Coors means that obviously big alcohol and beverage companies are very interested and believe that there's something there that matches their product line. Now, it makes the most sense for an alcohol company to get into that space because it's going to be a regulated retail experience. So it wouldn't be surprising to see cannabis beverages available through the beer store in Ontario, just the same way that beer and wine are available for sale through that regulated channel. we don't really know what the uptake is going to be. I think at this point in time, most people haven't had a beverage that has cannabis in it. And it may be that it's successful, it may be less successful, but the thing that we do know is that there's going to be a lot of attempts. One of the amazing things about the deregulation of cannabis is the opportunity set for including a variety of ingredients in a variety of other products that we're used to, whether it's the CBD or medical side and everything from pills, capsules, and oils to hand creams and other things on the beauty side, or when it comes to more the THC psychoactive side of the plant being involved in edibles and drinks and what have you. So we know that there's going to be a lot of money spent trying to try out these experiences. There's going to be a lot of marketing put into trying to get consumers interested in these experiences. And then our long-term view is that this shakes out, if you look out 5 or 10 years, to a point where there are cannabis product lines that are a key product line in a bigger consumer packaged good company that does drinks or edibles or what have you. And the cannabis becomes an ingredient that's a key part of somebody's business. And not necessarily the case that you have a new beer company that comes up from zero to control cannabis beverages. We think that that's less likely than this becoming a product line. And one of the reasons for that is that whoever is successful and finds the first success is likely to be a target of an acquisition from a big consumer packaged goods company, and those companies are huge. They've been around for a very long time. They're well capitalized, and they don't want to be left out. So I think that's where things are going, and in the meantime, the great thing for investors is investors today can get involved in companies that are trying some of those product formats out. Especially we'll see that in the fall of this year in Canada, and we already see it in the US. You can try it out for yourself. You can make your own judgment as an investor as to whether you think a particular product might be successful. And then if you invest in that company and those products do become successful, there's a reasonable chance that at some point that product will become part of a bigger product line from a larger company. And that could be a rewarding experience for investors if those things come to pass.
I see. Okay, Elliot, thank you so much for your time and for this update on the cannabis sector so far.
Thanks for having me.
For the Investing News Network, I am Brian McGovern. Don't forget to follow us on Facebook, on Twitter, and on LinkedIn. See you next time.